Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Hello, this is Rick D'Amico, Manager of Investments at Fairport Wealth. As a member of the investment team at Fairport, I'm primarily focused on managing the firm's fixed income and alternative investment strategies. I hope that everyone listening is staying safe and healthy through this difficult time, and I think I can speak for everyone in saying that we are looking forward to the day when we can see many of our clients in person once again. In this edition of Fairport Flash, we're going to give you our current thoughts on the equity market and also discuss the potential long-term ramifications that the COVID-19 pandemic could have on interest rates over the next several years. So let's get started. Since the last Fairport Flash, we sit approximately 1 month removed from the market lows set in March, and the good news is that the equity markets have recouped a significant percentage of its losses. In fact, the recent recovery represents the second best 1 month rally in history, returning 22.3% and trailing only the sharp move off the 2009 market lows. Historically, rallies of this magnitude have led to flat to modest short-term returns, and by short-term we mean over the next 20 to 65 days. However, longer-term performance has been much more encouraging. For example, the average return 250 days out is 20.6% and has been positive 100% of the time. So as strategic research points out, the next 30 to 50 days could be very choppy, but market returns 12 months out have come in well above the historical average. So this does give us some reason to be optimistic. That being said, and I'm always hesitant to say that this time is different, but this time, in fact, could be different as the world struggles to battle this global pandemic. It's unclear how long it will take to get back to a more normal economic environment or even quantify the extent of any structural long-term damage that has been done. The Federal Reserve has made it clear that it will do everything in its power to limit the magnitude of this damage, including slashing the Fed funds rate all the way to zero, intervening in every corner of the debt market, whether it be commercial paper, high yield, or municipal bonds, and boosting its balance sheet by $2.2 trillion since the start of the crisis. Cornerstone Macro estimates that the Fed balance sheet could balloon to $9 trillion by mid-June, then gradually decline to $8.1 billion by year-end. The size of the Fed's balance sheet will eventually be determined by how much demand there is for each of the COVID-19 liquidity facilities that the Fed has put in place. Let's discuss some of the long-term economic and financial implications of the crisis on the fixed income markets, as well as where interest rates could go. As Roberto Perli of Cornerstone Macro pointed out, 1 year ago the market expected that the Fed funds terminal rate would be close to 3%. Fast forward to today, and the market does not expect the Fed funds rate to reach 2% over the next 10 years. Given that U.S. Treasury rates are highly correlated to the movement in the Fed's fund rate, it is likely that U.S. Treasury yields will also remain low. In fact, current expectations, along with a negative term premium, imply that 10-year U.S. Treasury yields will only reach 1.35% 3 years from now. So it's reasonable to expect the Treasury curve could remain low for considerably longer than what was anticipated prior to the pandemic. Of course, this does have longer-term implications for fixed income returns. Going forward, it makes sense to add duration where appropriate, assuming we are likely to be in this lower for longer environment for quite some time. From a valuation perspective, credit does appear more reasonable, as even with the recent rally, high yield and investment grade spreads remain well above historical averages. For example, high yield spreads have narrowed over 300 basis points, but at 761 basis points are still higher than their historical mean of 547 basis points. Investment-grade credit spreads have narrowed from near 400 basis points to 211 basis points, but are also still north of their historical average of 157 basis points. Going forward, it will be important to continue to monitor the credit markets for further signs of stress. In our view, at this time, it makes sense to own higher credit quality assets or move up in credit quality as downgrades and defaults are likely to increase given the impact the COVID-19 crisis will likely have on the economy, not to mention the recent plunge we've seen in oil prices. West Texas crude recently traded negative for the first time as the price for the futures contract fell to a negative $37.63 a barrel. What this means is that sellers are actually paying buyers to get rid of it. With the pandemic bringing the economy to a screeching halt, there is now so much oil floating around that producers no longer have the room to store it. This will have a substantial impact on lower quality debt issuers within the energy sector. So in summary, we've seen a sharp bounce back in equities, but would expect continued volatility in the near term. The good news is that historically, returns 12-month out have been well above historical averages. We do realize that we've never seen a global economic shutdown of this magnitude, so this time could in fact be different. As far as fixed income, the likely impact is that rates will remain lower for longer, and it may make sense to add duration where appropriate, as well as move up in credit quality given the economic uncertainty that lies ahead. This brings us to the conclusion of this edition of Fairport Flash. As always, our goal is inspiring families, and as a member of the investment team, we seek to do this through a long-term and diversified approach. Please remember, even though some of us may not be physically in the office, we are here for you. Should you want to discuss any of the topics covered today in more detail, please reach out to your Fairport advisor. Thank you for listening. We hope you and your families remain safe and healthy through these challenging times, and we hope that you will tune in again next month.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims that make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.